And here is a third trade out of our series of bad trades from my track record. This one is one for the books. Because here clearly I made a mistake, clearly. And that mistake, I just know that everyone who trades has done a mistake like that before. Now, on the good side, I can tell you that already, that mistake wasn't as costly as it could have gotten or as it usually becomes for most people that make this mistake. These kind of mistakes normally take people completely out. And let me show you. So this is the Aussie Swissy weekly bullish structure, right? We can see here the structure's going up, right? Like higher high, higher low. But here we did not have a higher high. So this was more or less the same level, right? But in my rule book, that I don't have a rule for that. And trust me, I've gone through my trades and analysis and strategy development so many times that it doesn't make sense to have a rule here that would really, that works, that has a positive impact overall. So, okay. Because the price did not go that much down here, that would have invalidated the bullish trade idea, okay, generally. So that's why, okay, and it also went through here to the 59.40 level, 59.70 was this other zone. So generally, it is in an area where I would usually take a trade, okay? So all in all, the only thing that was not completely in place is that we did not have on a weekly structure a higher high, okay? So next one, the daily structure, we see just a classic retracement. Price was going up, then we have a correction, a little wave up, and then it stabilizes, right? We have that low here, it held on the average, and then you can see, okay, it goes back up, we have all the structure, and then you have this correction that comes down to this level. Not invalidated, again, 59.40, so it looks like, okay, this could be an interesting area to enter, right? So, and this is where the mistake happened. It is not a clean setup. And also, because you're a little bit too complacent, sometimes things click along well for a while, and then you just think like everything's going to be the same all the time. No, that's not how it works. But again, that's not the end of the world if you have your rules and everything else in place. Let me explain. So this is what happened here. So the idea was, okay, now it's correcting. We're taking it back on here to go for the new highs, and it's probably going to break up there. And what I did, that was on the 4-hour structure, and this is the difference. On the weekly and on the daily, you could argue there is a bullish structure in place. But on the 4-hour, there clearly isn't. Like we had this move up, and then this big drop, but there was no consolidation, there was no break and retest or any of these things. It was just basically holding on here. Some people would call it accumulation. Really, the word doesn't matter. The important part is that price did not really behave in any shape or form bullish just yet. But I was like, that's a trade. Let's do it. Again, because I didn't wait, and because the 4-hour structure was not bullish, for me, that means, okay, it's a very aggressive trade. And when I take an aggressive trade, it means it has a higher amount of risk than usually. Higher amount of risk than usually means I need to use a tight stop loss. Very important. When you take higher risk, you also need to secure your risk more closely, right? I mean, that's just pure logic. And you know that, again, from your strategy development process, from your backtesting, from marking out the charts, from trading the strategy, from going through these again and again and again. You just know that, okay, there are better setups and there are less better setups. And on the less better setups, the more aggressive ones, you just don't want to be on the wrong side. And that trade is a perfect example for that. Have a look at this. So I got into the trade and boom, immediately got stopped out. Immediately. It didn't even just punch me in the face. Okay, but now look what happened after. Because in a way, that was a good thing. And this is what happens to so many people. They rush into a trade, and they expect a certain move, in this case to the upside. The price immediately slaps them in the face down. They don't have a stop loss here. Then the price comes back up a little bit, and they're like, oh, the trade's going in my direction again. Everything's good. That's, by the way, gambling. And then, boom, this happens. I exited here. And this is a typical sucker in more liquidity type of move. And this is what market makers do, and then boom, the price goes further down. So it went to 59 now. And if you think that that was the end, because even here, a lot of people would then like, oh, damn, I'm down so much. What am I going to do? Hopefully the price going to retrace. I'm going to hold. Yeah, probably it will retrace. And then boom, it goes another 100 pips down. I got out here. So yeah, you could argue the entry was a little bit reckless, was aggressive, but that's why I secured my risk very tightly, extremely tight. A lot of people get in here, move this, and then over here again, they're praying to the trading gods. And then boom, this is how margin calls happen, especially if you have too much leverage going on as well. And that's just how retail people usually lose a lot, right? Oh, bullish structure, we're going to re-enter here. Up until here, we're all doing the same, but risk management is the big decisive difference. 100 pips, another 100 pips, and yeah, I did not eat 200 pips of loss. And that's extremely important. I'm showing you this trade is that, yes, I also do mistakes. Yes, I also have, I'm a human being. And yes, I still then, in these moments, I make, let's just say, not fatal mistakes. And that's very important that you understand that. When you trade statistically and with rules and process-based, you're not looking to flip a trade in order, or flip an account with a trade, take that much of a risk that it would double or kill your account more or less. No. And that's extremely important that you understand that if you want to survive long term. I don't know a single trader, not one, who's really gotten rich off trading fast. I know some of them that got a lot of money quickly, but it took them some time to get to a certain account size, and then they did that. Or most people that I know that have real wealth from trading or financial markets actually took them some time to do. Because also, don't forget about that, once you have a certain amount of money, you need to be able to manage that amount of money too, to keep that money and grow that money even more. If you go from 0 to 100 grand, which by the way is chump change, yeah? I don't want to sound arrogant, but 100 grand is not going to get you through life. And then you just risk the 100 grand and then you lose it, what's the point? But if you build little by little by little by little, and little is a lot, actually it accumulates. And that's how you build wealth really, right? So don't be the idiot that enters on, all right, okay, I was an idiot, that entered on a not the best setup here. But again, use tight risk management when you do that. So what could I have done differently here? First of all, never catch a falling knife. I mean, everybody knows that. But really, wait for a proper structure first. So if that price, because this move is violent, and we didn't really have something proper here, if it would have shown us to go above that, resistance area and then retested, that could have been a much smarter entry. But that would have taken, more patience and all these beautiful things that we as human beings are so naturally wired to, right? You understand what I'm trying to say? So this is what I could have done better. I rushed into a trade, but okay, I took very tight risk management. So that's something that I could have done differently here. And because also another thing, even on the 4 hour, the price here was trading below the averages, right? So even if we had this correct, like break up first and then retest, at least one of them would have been here. So even that was not really in line with my rules completely. That's why I'm saying, like, in the heat of the moment, you apply discretionary decision making. Sometimes it works, sometimes it doesn't. But even if it doesn't, you have to make sure that within your discretionary decision making, the risk management aspect is where it needs to be. Or otherwise, you're down here and you're crying tears. Okay? So yeah, that's another bad trade here. And you just see, man, it was also not a short setup. Like, okay, you could argue, like, why did you not sell? Because there was not a short setup neither, right? Again, on a weekly and a daily, we had a bullish structure. So that's not something that I could have done differently neither. So the learning is, I did not follow my trading plan correctly. I need to slap myself in the face for a moment and then go and do it correctly again. But I prevented more damage by strict risk management. So all in all, there was a learning in here. A learning that makes sense. So there are no bad trades per se if you make sure that when you lose, they don't kill you, right? And you have proper learnings from every single trade that you do. For that, you need to have the statistical method, you need to journal your trades, you need to review your journals, and you need to be honest with yourself to do all these things, right? And this is how you build consistency, track record, over 100%, month after month in profit, even working out through drawdowns multiple times. That's how you do it. No magic, just a statistical edge type of process. That's real trading in my world.